Hey guys, today we want to talk all about opportunity cost. How should we be making financial decisions? Should we pay down debt? Should we invest more? And what are we missing? What are the two components that go into that decision-making process for determining what's the best move for you financially? But if this is your first time joining us, welcome. My name is Michael Foley. I'm a certified financial planner and a certified student loan professional, and I'm also the son of two doctors, and I've really developed Lifestyle Creep to help the healthcare workers in our society really develop a better relationship with money and hopefully help them to be more intentional in their finances through the simplified education. So excited to dive into this with you, and let's take a look. So let's talk about opportunity cost. So for some of you guys, if you've ever taken an Econ 101 class, this would probably be in it. But essentially what opportunity cost is, it says, well, if I have an extra dollar, should I, if I put it towards this area, it's essentially me voting to say that I don't think that I can do better in any other area. So what am I potentially missing out on if I were to put that money that I'm putting towards this area towards some other area, right? So for example, if I have money that I'm going to pay down towards a student loan, maybe at 6% interest, it's saying, well, I'm thinking that I'm going to pay off this 6% interest student loan, but could I potentially earn more than 6% in some other area? It's kind of the conversation, right? So the big two components that I want to break down when we're looking at trying to compare these different options in your situation are interest rate and taxes, okay? So most people only look at the interest rate component, and so they say, well, I have a car loan that's at 4% interest that's charging me. I'm not going to pay any more, not a dime more towards that, because I can earn 4% in my online savings account, right? Well, that would make total sense if you're only looking at interest rate, but as we'll see, once you factor in taxes into that equation, that might change the game a little bit, right? So I ran a couple different examples just so you can see apples to apples and the different ways that these different accounts are attached, so you can get a true representation of what is a comparable interest rate when you're actually looking at trying to make a decision between these different scenarios, okay? So looking at just like an online savings account, so I just looked at my Ally Bank account right now is making 4.25% interest, and so this is as of 2024. And but right now, if let's say for example you're earning a household income of 400,000, and let's say you have you're a married couple filing jointly, okay? So that's going to put you at that upper bracket. So any additional dollar will be taxed at 32%. That'll put you into that next tier. So again, if you reference our other tax video, it's not that your whole income's getting taxed at that 32%. It's just that marginal amount more above certain thresholds, right? But if we are earning any more interest through this online savings account, that 4.25 is actually going to get taxed at 32%, right? So it's a really steep, because that is called earned income. So anytime we get interest from an online savings account or the like, you have to pay it as if you earned that money in that given year, right? So you don't get any preferential tax treatment like you do in some other investment accounts. And so that 32% really brings that down to a net earnings after taxes of only like 2.89%, right? So that's a lot different. So now if you're saying, hey, I got this 4% car loan that, and instead of putting it towards that, I'm going to put it towards my online savings account. Well, really, you can see that now you're actually losing money by a good margin there by putting it towards the online savings account as opposed to paying it towards that debt, because really the numbers are not actually shaking out in your favor anymore when you factor in taxes. So that's why it's so important to look at both of these. Okay, so now I use this 2.89% just to show you kind of in different types of accounts how the tax ramifications can change that, right? So in, let's say, a taxable investment account, so this might be just a general brokerage account that you might have that, it's not a retirement account. This is just a general taxable account that you and your spouse might have, or maybe have an individual account. This is where you're invested in stocks and bonds and other what we call equities. And so if you buy a stock and you hold that for over a year, you get to take advantage of what we call long-term capital gains rates. So long-term capital gains rates, depending on your income, is somewhere between 15 to 20%. So again, in that same situation, if you're earning about $400,000, you're going to fall into that 15% bracket. And then most states have maybe a 3 to 5% state capital gains tax on top of that. And so let's call it 20%. So as you can see, already better than this other alternative here. So you're getting a lot less. So that therefore, to get that 2.89% after taxes, we only had to earn 3.69% in our investment account. So although we're earning less interest and we're getting taxed less, so therefore these are all kind of equal when you look at it in that regard, right? So we don't have to earn even as much because we're getting preferential tax treatment in the investment account. Okay, so that's helpful to kind of break it down. But then we got to look at it. Let's say we already have a debt that's outstanding. Well, when you pay down a debt, well, you don't have to pay any taxes on that, right? Because you've already taken it out and you're paying that off. And so if you're paying that off, you're actually reaping the reward of that exact interest rate. So let's say we did, again, try to keep all the numbers the same. We had that 2.89% interest. We're getting that exact 2.89% after taxes. So again, if you have that 4% car loan and you put money towards that car loan, you're getting exactly 4% on that, right? You're not having to factor or reduce any other taxes. Whereas if you get 4% in an online savings account or 4% in a tax pool, we're going to have to factor in taxes into that equation. So we got to earn more than that to compete with that. So when we're looking at any sort of debt pay down or investing, and trying to decide where should we be putting our money, please do not forget about incorporating taxes into that. So obviously, as we're seeing, there's different types of ways that these different accounts can be taxed, but it really is if we're only looking at the interest rate and determining which one is a better scenario for you, you might be misled if we're not factoring taxes into the equation. Okay, so hopefully this is helpful to really kind of break down how should we be making decisions when it comes to paying down debts, to building investments, or what to be doing with extra money. But hopefully helpful to understand the different tax code on that. So thanks for joining us, and we'll look forward to seeing you in the next episode.